Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your market compass for the week ahead for June 8th, 2026. Markets enter this week focused on four major pressure points: inflation, Treasury yields, energy prices, and geopolitical risk. Together, these four forces are shaping investor expectations and driving market behavior. The central question investors are asking right now is simple. Can the economy continue growing without forcing the Federal Reserve to keep interest rates higher for longer? That question sits at the center of nearly every major market conversation because stocks, bonds, and commodities are all trying to price in a world where economic growth remains resilient, but inflation risk may be rising once again. Let's begin with what happened last week. Major indexes delivered mixed results. The Dow Jones Industrial Average continued to demonstrate relative strength and finished near record territory. The S&P 500 remained relatively stable. Meanwhile, the Nasdaq experienced increased volatility as portions of the technology and semiconductor sectors saw profit-taking after a powerful multi-year advance driven by artificial intelligence investment. The biggest economic story of the week was the May employment report. Job growth came in stronger than expected, reinforcing the view that the labor market remains healthy and that the U.S. economy is not showing signs of imminent recession. From a market perspective, strong employment is a double-edged sword. It supports consumer spending, it supports corporate earnings, and it supports overall economic activity. However, it also reduces the urgency for the Federal Reserve to cut interest rates. Bond markets reflected that reality. Treasury yields remained elevated as investors reassessed the likelihood of near-term rate cuts. That's an important development because higher yields can place pressure on both stocks and bond valuations. Sector leadership also became narrower. Defensive sectors held up relatively well, while portions of technology experienced profit-taking. Market breadth remains an important area to monitor. For a sustainable advance, investors want to see participation broaden beyond a handful of mega-cap leaders. Areas such as healthcare, financials, industrials, and consumer-related sectors will need to participate if this rally is going to remain durable over the long run. Now let's discuss the current market thesis. The market's primary narrative remains centered on a soft landing. Investors are betting that economic growth will slow enough to eventually bring inflation lower, but not slow too much that the economy falls into recession. That assumption continues to support current market valuations. Markets are also assuming that corporate earnings can continue growing despite elevated borrowing costs and ongoing geopolitical uncertainty. The challenge is that this thesis now depends increasingly on energy prices remaining contained. If geopolitical disruptions begin feeding through to transportation, manufacturing, and consumer costs, the path towards lower inflation becomes more complicated. That brings us to the week ahead. The most important report this week will be Wednesday's Consumer Price Index. Markets will be looking closely at whether rising energy costs are beginning to show up in broader inflation measures. A hotter than expected CPI report could push Treasury yields higher and create additional volatility across both stocks and bonds. A cooler than expected reading could support the case that inflation remains on a gradual downward path. Thursday brings the Producer Price Index, along with weekly jobless claims. Friday delivers the University of Michigan Consumer Sentiment Survey, which has become increasingly important as inflation and energy prices influence household expectations. Investors should pay close attention not only to the inflation data itself, but also to how Treasury yields respond afterwards. The bond market's reaction may ultimately tell us more than the headline inflation number. In short, inflation remains the dominant economic theme this week. Now let's discuss geopolitics. The situation involving Iran and the Strait of Hormuz remain one of the most important risks facing global markets today. While markets have avoided a complete global energy crisis, the economic friction is already visible. We are now roughly 100 days into the regional conflict involving Iran. Shipping traffic through the Strait of Hormuz remains drastically below normal levels, and energy markets continue to reflect elevated supply concerns. Investors should recognize that this is no longer merely a geopolitical headline. It is becoming an inflation variable. Why does this matter financially? Well, approximately 20% of the world's oil supply normally moves through that region. When investors feel supply disruptions, oil prices rise. Higher oil prices increase transportation costs. They increase manufacturing costs. They increase airline costs. And ultimately, they raise consumer prices. That creates inflation pressure. Inflation pressure can delay Federal Reserve easing. Delayed easing can keep interest rates higher, and higher rates can weigh on both stocks and bonds. This is why investors should pay attention not only to military developments, but also to energy markets. At the moment, markets appear to be pricing stabilization. They are not pricing full normalization. That distinction is very important. Stabilization means conditions have stopped deteriorating rapidly. Normalization means conditions have returned to historical norms. We're not there yet. Now, what does this mean for you, the investor? For investors with a higher risk tolerance, opportunities may continue to exist in areas benefiting from economic resilience, infrastructure spending, industrial activity, artificial intelligence, and selected energy-related sectors. However, volatility is likely to remain elevated as markets react to inflation data, interest rate expectations, and geopolitical developments. For investors with a lower risk tolerance, this may be an appropriate time to review fixed income allocations, maintain adequate liquidity, and ensure portfolios remain aligned with long-term objectives rather than with short-term headlines. For everyone who's investing, the message remains the same. Stay disciplined, stay diversified, and avoid allowing daily headlines to dictate long-term financial decisions. Markets continue to navigate a complex environment where inflation, interest rates, energy, economic growth, and geopolitics are all competing for attention. The path forward may not be smooth, but disciplined investors have successfully navigated similar environments before. Stay focused, stay disciplined, and as always, stay oriented and elevate your legacy.